If you're looking for an investment solution with upside potential and downside protection, is Alpha Architect's VMOT the right solution for you? So a couple weeks ago, I went over my portfolio and I revealed my holdings. And someone realized that, VMOT is a huge amount of my current exposure, which made them look into the fund. And let's be honest here, this fund has had really bad performance. So this video, I kind of want to go over VMOT, the construction, the fees, the expenses, how you could include it into a portfolio. But the main point is what I'm trying to forensically look for is asking myself, is VMOT just a bad ETF, or has it just had bad luck with timing? Because if it's just the latter, you might be looking at a fine, acceptable performance for what this thing is targeting. If it's not, if it's something systematic with the way it's constructed, then we can maybe conclude that it's not a very good ETF. Spoilers, I think it's a really good ETF because I hold it, but that has to do more with the systems of how it's constructed. First off, if you know anything about Alpha Architect, it is like the blue meth of factor investing. These guys are building super concentrated funds that load into factors where we are targeting potentially the highest expected returns. And we're just letting the chips fall where they may, right? Like these ETFs are going to have huge tracking error, really bad performance over short periods of time. Now, VMOT is pretty self-explanatory how this thing is constructed, is value, momentum, and trend. And if you look at this graph right here, you'll see it has exposure to basically all their ETFs, QVAL, IVAL, QMOM, and IMOM, which again are US and international value and momentum ETFs. And then it overlays a sort of trend following exposure on top where they might hedge. If the market hits some rules, some systematic rules, they are going to hedge their portfolio. Again, trend following, the idea here when hedging is not that you're going to make more money over the long term, though, depending on your luck, you might or might not, but that you're targeting similar expected returns with the potential avoidance of a 50% plus crash that obviously, because of the way this is constructed, has to be a sort of slow moving train wreck, close to what 2022 and 2023 have been. This is usually where portfolios like this or ETFs like this really shine. So I really want to pause here to reveal or reiterate something. What we're doing here is targeting what I believe and what they believe are the highest expected returns, right? This is the math that's going to get you the returns over the long term and mitigating on the downside. This seems like a pretty well-rounded fund in my view. It sort of has all the three things I really believe in, which are value, momentum, and trend following. So it kind of makes sense for me to have such a large exposure to this ETF. But since this ETF is a fund of funds with a sort of overlay on top, we can't really do justice to it unless we actually go into the funds and discuss the way these funds are constructed. Now, this is not going to be an hour-long video. I could actually go through the momentum and the value, and even to a certain extent the trend following portions here, and make a whole video about them. Actually, there's whole books written about this strategy. You can actually look at exactly how these things are constructed. Quantitative Value, good book. I recommend people read. Although I must say fundamentals bore me just naturally, like I just don't like accounting. But it's a really good book that explains the sort of process in order to target expected returns with value. Quantitative Momentum, which is actually my favorite book out of those two, because it was really my first exposure to momentum. But secondly, I like technicals more. I don't necessarily believe in them more. I just like the subject, and I think it's a little bit more entertaining and more catered to what I enjoy. And that book really opens the book on their momentum strategies. Again, giving you literally a formula that you can follow. But that doesn't mean that these things are just super simple to implement. Obviously, there's a lot of research behind it, so you can read those books to understand more. But I'm going to give you a sort of Cliff Notes version. So let's first start with the value component here. As you can see, we are going to be following the quantitative value strategies. First thing you do is identify the universe. Again, we are looking at a 1,500 initial stock universe. We are excluding financials and illiquids. The reason for excluding financials has to do a little bit more with the metric that is being used, plus a little bit more of a quality check on these strategies. The second thing, we're gonna remove red flag firms. Again, all systematically done. We're gonna remove outliers that have potential problems with financial reporting / highly distressed stocks that are near bankruptcy. After we have this sort of universe of 1,000 firms, you are going to take the top 100 based on EBIT to TEV. Now, EBIT to TEV is an overlooked, potentially an overlooked metric for value investing. All it's doing is it's taking EBIT, meaning the earnings before interest and tax, and then we divide that by TEV, which is the total enterprise value. So you're looking at the bond market cap, the equity market cap, the preferred market cap, you're reducing cash. It's been called the acquirers multiple because, again, if you as a single person wanted to buy the whole company, you would have to come up with the cash to buy out everyone, pay the bondholders, pay the stockholders, buy all their stock, buy the preferred stock. And again, because you're buying the whole company, you're receiving cash. So really subtract the cash because it's going back into your pocket. And there you have it. You have the total enterprise value. Value metrics will look at things like price to book or the PE or price to cash flow. But all these multiples are basically looking at the equity portion only, where EBIT to TEV has some sort of strengthening, being able to look at the whole firm. Historically, it has performed best or better than PB or PE or PCF. Currently, as I'm recording this, it's probably the preferred way to look at valuations because the valuation spreads are ginormous. So if there's going to be a sort of mean reversion in the future where value stocks start outperforming, the returns could potentially be enormous. So at least there's some potential extra returns that you can gain by targeting this metric as opposed to price to book, which has actually done better than total enterprise values since the COVID drawdown. And the last step in actually both strategies is a quality score. So you eliminate the bottom 50% based on quality metrics, and you end up with this equal weighted portfolio of 50 stocks. Now, 50 stocks, very concentrated, of course. And the reason we're looking at this concentration is because, well, the more concentration you have in factors potentially means better expected returns with a whole lot more tracking errors. So this thing is going to look very volatile. It's going to look different from the market. But again, based on this research, you're actually targeting what you should be targeting in the value factor. Next, let's go through the momentum strategies here. We'll start with the 1,500 initial stock universe. Again, we remove red flag firms. We end up with 100 based on 212 momentum. So let me talk about 212 momentum since I talked about TEV. Basically, we're looking at the stocks that have performed the best over the past year while we ignore the last month. Now, the reason for the last month is because there seems to be some sort of mean reversion. Usually stocks that do well or have done well in the past month will do worse in the next coming month, and stocks that have done badly over the past month tend to do better the next month. So in order to take into account the noise that is the last month, just generally speaking, well, we just remove the last month. And so we look at 11 months of data based on 1 year minus 1 month. So after we have chosen our 100 best performing stocks, then we go and eliminate the bottom 50 and we select the top 50 in terms of quality. We've all heard that story that if you put a frog into a pot of boiling water, the frog is going to jump out, versus if you put them in cold water and then you boil them up slowly, then they'll die. Actually, I heard somewhere, this is beyond the point, but I've heard somewhere that this is actually not true. But I think the allegory still stands, and I think it's a fine allegory to use. But the idea is that we are targeting momentum stocks that have this sort of slow building momentum again, where the stock is going up slowly but surely, because that's potentially where we are prone to seeing more behavioral errors than something that jumps really quickly, because then at that point you could say it's more efficiently priced. Generally speaking, you see this more in biotechs, this huge jumps where drugs get approved, then the stock roars up like crazy. But that's not really momentum. That's just efficient pricing being efficient. What brings about the momentum factor is more of this underreaction to good news, potential overreaction towards before mean reversion, right? And so that slow moving quality check is really important within this strategy. Lastly, we have the top 50. We rebalance quarterly. Not to go into this too much, but there is a sort of premium you can earn if you rebalance your momentum strategy on the month before the quarter ending month. So you're looking at February, May, August, and November. Lastly, let's look at the trend component and see how they handle trend following. So again, let's look at this graph here. We have two asset classes. We have US equity and international equity. What we're going to do here is use an ensemble of two rules. One is time series trend following, and the other one is moving average trend following. So time series trend following, all it says is if in the past year, the index, let's say for the US market would be the S&P 500. If the S&P 500 is down over the past year, well, we could say it's negative momentum or negative trend in this case. And so we are going to hedge. The second part is moving averages. And I have a video that you can look at where I actually go over this a little bit more. But you're just looking at the closing prices for the past year and then forming this sort of slow moving average. And if you are above the slow moving average, you can go along. And if it's below the moving average, you would go short the index while still having exposure to value and momentum, meaning you are hedged while still keeping factors somewhat intact, not fully intact, because again, if you're going into value, you would have to short the opposite end, meaning the most expensive stocks based on EBIT to TEV, or momentum shorting the stocks that have done the worst over the past year. So it's not exact hedging, but there is some sort of research also that looks at indexes being shorted instead of actually shorting the opposite end of the factor, bringing about better returns. I don't know too much about it. I just know it exists. And I'll bring a video once I know what I'm actually talking about here. But you're hedging, again, the market, the beta exposure, while keeping some of the metrics, so some of the value and some of the momentum factors within this strategy. Once we determine our trend following rules, we are going to hedge anywhere from 0, 50, or 100% based on the moves of the indexes. So it's a little bit more dynamic on when it hedges. It could be 50% hedge or 100% hedge, or it can have no hedge. So let's come back. There's a lot of information there. And let's actually now look at how this whole thing gets put together. Here's the graph. The first thing we're going to do here is identify the weights in the value and momentum strategies. Then we determine the US equity hedge and the international equity hedge. Then you deploy the hedges based on the trend. And then finally, you end up with this about 200 stock portfolio with the potential to hedge before the market drops 50+%. So coming back and putting everything together, what I love about this ETF is the duality. It's the whole, we have a potential upside, being able to hedge yourself, your own behavior when the market drops. I keep saying that over and over, and that's because it's true. The problem is not losing 50% of your money. Tons of investors have gone through it, and they come out the other end fine. But a lot of investors don't. And why don't they? Well, they sell when they shouldn't sell, because risk is dynamic. Risk is not necessarily constant. People look at risk differently depending on the situation. And so what I'm trying to hedge here is not the market. I'm trying to hedge me. I'm an idiot, okay? Or at least we should consider the possibility that we don't know how we will act in the face of danger. And so, hedging a little bit, even having a little bit of exposure to VMOT seems to me like a sensible thing to do. You should be expected to have the gains of the buy and hold counterpart while still avoiding that drawdown. But again, as you do that, you're going to experience a whole lot of tracking error. And that brings me to the performance of VMOT, which has not been the best performing. Now, you could look at this graph and say, look, this thing is stupid. Do you see how ugly this thing looks, right? And your number one conclusion should be stay away from that system. Or the second thing you can ask is, why does it look like this? And this thing had really bad timing. Now, as someone who has seen the index and how it has performed before the launch, this index would have been the best thing, the super best thing to own in the 2000s, because not only did value work, international also worked, and trend following killed it twice. It twice avoided a 50% drop. But then as you transition to something like the teens, well, this thing sucked. And actually from 2009, from the bottom of 2009 to today, this thing has underperformed the S&P like crazy for the same reasons, because value hasn't worked, because trend hasn't worked, and because international diversification has been nothing but absolutely awful to have. And then we bring back this whole discussion about risk. What is risk? Is risk looking different from the market, looking different from your neighbor, or is risk a huge drawdown? There might not be a specific answer I can give you, but what I do know is that for me, the drawdown seems way scarier than looking different from my neighbor. If I'm taking the risk that I should, then it doesn't matter what my neighbor's doing, because guess what? My investments are my personal investments, and they fit a portfolio for a person that has a life that's different from my neighbor. My neighbor has a 9-to-5 job. I don't, right? Like that should already change things. I have a kid and a wife and a dog, which doesn't actually change things too much. But I have exposure to different sources of risk, and so my portfolio should take that into account. Therefore, tracking risk, tracking error might not be so much of a risk as opposed to a deep drawdown, right? If the economy goes down and I as a freelancer start losing money, that's bad news. And so I should act and put my portfolio in a certain manner that responds properly to that sort of situation. Now, going back to this graph of looking exactly at how VMOT has performed, we had a horrendous whipsaw in 2018, basically a V-shaped recovery. Well, this thing hedged, and then the market ripped back up, and then it unhedged, and then it actually went back down. And so it got whipsawed like crazy in 2018. Fast forward to 2020, it hedged half of its portfolio before the March drawdown, which was good, but it wasn't enough to fully hedge that out. As we know, April, the market came roaring back up, being fully hedged then, or at least partially hedged. And then you had this crazy bull run to the peak of 2021. Basically, we're looking at GameStop highs. And then international had a huge drop again, November of 2021. And then we're looking at some sort of hedge position now, where this ETF is now starting to show its benefits, though I have to say March has been horrendous for value again, underperforming the S&P again. And so we are kind of in this mush where some of the days this ETF, the underlying holdings are ending in the red, and then the indexes are ending in the green. So being hedged is actually hurting you too, because you are short something that is doing well on some days, and then being long on things that are not doing good. So it could look messy, and it's overall a messy picture to look at. So is this thing broken while looking at this performance? Not really. The rules are so simple that I conclude that this is just part of the game. This is what happens. This is the distribution we are in. We're in a world where nothing but the S&P 500 has worked up until now. And I think going forward, I'm really interested in seeing the performance of this when valuation spreads are crazy and haven't compressed yet, where the S&P is still expensive, where trend following may have another decade of good performance, depending on whether this crash is an actual real crash or if it's just, again, a little bit of noise. I have to be honest, I'm glad I'm in this ETF because I wanna be hedged, or as hedged as I can be right now, just based on my emotions and based on what I'm seeing here. But I might be wrong. So if I'm wrong, then I'll be glad this thing takes the hedge off when it needs to, and hopefully I can ride the wave back up. So potentially, I see this ETF as being really well posed to our times. It is the ETF that I think people should consider. Just consider. I'm not telling you to invest. Just consider it for a time like 2023. Before going into our last section here, just wanted to let you know about Slow and Steady, which is an email newsletter I run. I send out emails every other week with bite-sized, practical, personal finance tools and tips. So make sure you check that out and subscribe. Lastly, expenses, and this is something I need to go over because it is a misunderstanding. Let me show you the expenses here. It looks super expensive, 2.55%, but that's not, it's not that it's not right. It's just that it's not painting the whole picture. When you short an ETF, in this case, VMOT hedges using shorts on an SPY and EFA, which is the S&P 500, and then the developed international market ETF. When you are short at any given point, if you receive a dividend, that dividend does not belong to you. You have to give it to the person who you are borrowing the ETF from. So that gets imputed into the cost, but what's important here is looking at the actual cost. And the management fee here is about 45 basis points. You also have on top the ETFs, the underlying ETFs have an expense that is then waived back down, and then it gives us a 69 basis point sort of base. And then you have other expenses that run about 6 basis points, and it brings the whole ETF to about 69 to 75 basis points. It is a little expensive just because of the nature of what it's doing. You have a very highly concentrated portfolio of stocks, and not only that, you're also using hedging to your favor. So it should, because it's a little bit more active, then it should be more expensive. What I think people should take into account, and this goes into the construction of how you could use this ETF, is that, the philosophy here, or the philosophy of the Alpha Architect people, is that you don't necessarily need to hold this 100%. I hold a whole lot more than maybe I should, but, when you think about it, this ETF is a package of factors and trend following that, if you were interested in holding something like this, could be combined with a little bit more of a soft passive holding. So you could go VT and VMOT. For example, I'm just going to throw a portfolio here, a 75% VT, globally diversified market cap fund, very passive, very cheap, and then add some factor exposure to it. And, it hedges you a little bit too, which is great. And so you're reducing the cost by combining this ETF with other ETFs that tend to be cheaper and get you some sort of core holdings if you decide to go into 100% VMOT. It's going to suck. The tracking error is going to be the worst thing you've ever experienced. You're going to have a lot of constant losses, meaning when you hedge, most of the time is a false signal, meaning you're going to lose on that end. And you have to be okay with losing 70, 80, 90% of the time. And, it's kind of some sort of, if you think about it, some sort of positive skewed distribution where every once in a while you will feel this euphoric high because, well, everyone is losing on your hedge. You are sort of trying to eliminate that far left tail. In conclusion, if you like eating tracking error for breakfast, lunch, and dinner, you could consider going 100% into VMOT. That is potentially really crazy, but a 25% VMOT, 75% VT allocation to your stock, to the stock portion of your portfolio, seems to me like a sensible way to go about this if you're interested in it. Again, you have to be really on board with both value and momentum, and also trend following, and hopefully having some faith that over the long run, all things just kind of mean revert, and, trend following and buy and hold just kind of end up being sort of the same thing. What do you think of VMOT? Let me know down below in the comments. We'll hash it out. As always, thank you so much for watching. You can go to slowbrewfinance.com, and there, make sure to subscribe to Slow and Steady, and I'll see you next time. What are the odds I get a VMOT tattoo?